In October 2008, two retirees in the same Ohio suburb opened their quarterly statements on the same Tuesday morning. Same age, same career, both retired engineers from the same plant. Both had saved for 35 years. Both had what their advisors called balanced portfolios. Robert opened his and saw he was down $312,000. On paper, almost 40% of everything he'd built. He spent that night at his kitchen table with a yellow legal pad, calculating which year he'd run out of money if he lived to 85. The number he wrote down was 76. His neighbor Frank opened the same envelope from a different brokerage and saw he was down about 9%. Not nothing, but survivable. Frank went to bed that night and slept. Same crash, same town, same age, same savings amount, give or take. One man's retirement was statistically broken by a singly Tuesday in October. The other man's wasn't. The difference wasn't luck. It wasn't a hot stock tip. It wasn't a guru. It wasn't even really about being smarter. Frank's portfolio had three specific characteristics that Robert's didn't. Three signs that a pile of money has been built to survive what's coming, not just what already came. And here's the part nobody tells you. Those same three signs would have protected savings in 1929, in 1973, in 2000, in 2008, and in March of 2020. Every major crash of the last 100 years, the same three signs, every single time. I'm going to tell you what they are, and I'm going to tell you which one Robert was missing. The S&P 500 has had, depending on how you count, somewhere between 10 and 13 drawdowns of 20% or worse since 1928. The average bear market takes roughly a year to bottom, and historically several years to fully recover in real terms. The 1929 crash erased about 89% of the Dow at its trough and took 25 years to make investors whole nominally. The 2000 NASDAQ crash erased about 78% and took 15 years. The 2008 S&P 500 crash erased about 57% over 17 months. Those three facts are connected, and most retirement planning ignores the connection. Here it is. The math of retirement isn't built on average returns. It's built on the sequence of returns. A portfolio that earns 7% a year on average can still go to zero if the bad years come first and you're withdrawing money. This is called sequence of returns risk, and it is the single most underestimated force in retirement planning. The villain in this story isn't the crash. The crash is just weather. The villain is a portfolio designed for sunshine sitting outside in a hurricane while its owner keeps pulling money out of it. I've spent years analyzing historical market data, not predictions, not forecasts, the actual record of what happened to real portfolios in real crashes. I look at the data nobody puts in the brochures. If that's the kind of thing you want more of, hit subscribe. I break down the patterns most people retire without ever being shown. And the like button tells the algorithm to show this to the people who need it most, which right now is people Robert's age who still have time to fix it. Over the next few minutes, I'm going to walk you through the three signs, the three characteristics every crash-surviving portfolio in history has shared. Then I'm going to do the math on a real $400,000 retirement account so you can see exactly what this looks like in dollars. And then I'm going to give you three things you can do this week. Not theory, not consider diversifying, actual steps. Let's call the framework what it is, the three-anchor portfolio. Not because I invented anchors as a concept, but because that's what these three characteristics actually do. They anchor your money to the ground when the wind picks up. Every portfolio that has survived every major crash in the last 100 years has had all three. Portfolios with two of the three got hurt but recovered. Portfolios with one or zero, those are the Roberts of the world. Anchor 1 is non-correlation. That means owning at least one asset class that does not move in the same direction as your stocks during a panic. Anchor 2 is income that doesn't depend on selling anything. That means a portion of your money throws off cash whether the market is up, down, or closed. Anchor 3 is what I'll call dry powder, a deliberate, boring, unglamorous cash reserve sized to your actual spending, not your advisor's risk questionnaire. You'll hear me come back to those three words: non-correlation, income, dry powder, because they are the spine of this whole thing. Every crash in modern history was survived by people who had all three. Every retirement that broke during a crash was missing at least one. Here's the proof, and it's the part most channels skip. In 1929 through 1932, the Dow fell about 89% peak to trough. Investors who held a meaningful allocation to long Treasury bonds, which rallied as the Fed cut rates and deflation set in, saw those bonds gain roughly 15 to 20% over that same window. The non-correlation anchor did exactly what it's supposed to do. In 1973-74, the S&P fell roughly 48%, and inflation ran hot. Stocks and bonds both struggled in real terms. The people who survived that one in real purchasing power had exposure to gold, which had been freed from its peg in 1971, and ran from $35 an ounce to over $600 by 1980. In 2000-2002, the Nasdaq fell 78%. Boring, dividend-paying value stocks, utilities, consumer staples, were roughly flat to modestly positive over the same window. In 2008, the S&P fell about 57%. Long treasuries gained roughly 20%. In March 2020, the S&P fell about 34% in 5 weeks. Long treasuries again rallied sharply as the Fed cut to zero. Different crashes, different decades, different causes. Same lesson. Something in the portfolio has to be moving the other way. Now let's get into the three anchors individually, and I'm going to be honest with you about each one, including what it can't do. Anchor 1. Non-correlation. The claim is simple. At least 15 to 25% of a retirement stage portfolio should be in something that historically rallies when stocks panic. The two assets with the longest track record of doing this are long-duration U.S. Treasury bonds and gold. Long treasuries, the kind held by funds like the iShares 20-plus Year Treasury Bond Fund, ticker TLT, rallied during the 2008 crisis and again in March 2020. Gold rallied across the 1970s stagflation and again after 2008. The mechanism is real. In a deflationary panic, investors flee to treasuries and the Fed cuts rates, which pushes long bond prices up. In an inflationary panic or a currency confidence panic, investors flee to hard assets and gold gets bid. Now, here's where I have to be honest with you. Non-correlation is not the same as anti-correlation, and the relationship is not a law of physics. In 2022, both stocks and long treasuries fell at the same time as the Fed hiked aggressively. The TLT lost about 31% that year. The classic 60-40 portfolio had one of its worst years in history. That was a sequence the textbook didn't account for, which is exactly why the second and third anchors exist, because no single anchor holds in every storm. How to act on it? Most retirement stage investors are underweight this category. Look at your current allocation and identify what percentage is genuinely non-correlated to the S&P. Not international stocks. Those crashed with the S&P in 2008 and 2020. Long treasuries, intermediate treasuries, gold via funds like the iShares Gold Trust, ticker IAU, or the SPDR Gold Shares, ticker SPDY. The historical evidence supports somewhere in the 15 to 25% range for someone in or near retirement. Verify with your own situation. Anchor 2. Income that doesn't depend on selling. This is the most underappreciated anchor in modern retirement planning, and it's the one most damaged by the era of zero interest rates we just left. The principle is straightforward. If a portion of your portfolio pays you cash, dividends, interest, rent, you do not have to sell shares during a crash to fund your spending. And not selling during a crash is, mathematically, the single most important behavior in retirement. Here's why. If your portfolio drops 40% and you sell 5% of it to live on, you've now permanently converted a paper loss into a realized loss on those shares. They're not there to recover when the market comes back. This is sequence of returns risk in plain English, and it is what broke Robert. He had to sell into the 2008 crash to pay his bills. Frank didn't, because Frank had dividend income, bond coupon income, and a small rental property that paid regardless of what the S&P was doing on any given Tuesday. The mechanism is that income is psychologically and mathematically different from price appreciation. A dividend from a 100-year-old utility doesn't care what the NASDAQ did this week. The bond coupon from a treasury arrives on schedule. The rent check shows up. Now, here's where I have to be honest with you. Chasing yield is one of the most destructive habits in retirement investing. A stock paying 12% is usually paying 12% because the market thinks the dividend is about to be cut. Mortgage REITs, business development companies, and certain high-yield bond funds have a long history of cutting payouts at exactly the worst time. The goal is reliable income, not maximum income. The dividend aristocrats, companies that have raised dividends for 25 years or more, have a far better record than high-yield chasers. But they yield less. That trade-off is the trade-off. How to act on it? Calculate what percentage of your annual retirement spending could be covered by dividends, bond interest, Social Security, and any pension without selling a single share. If that number is under 60%, you have an income anchor problem. Funds worth researching include broad dividend ETFs, intermediate treasury funds, and treasury inflation-protected securities, known as TIPS, held in tax-advantaged accounts. Quick interruption. If this is the kind of breakdown you wish someone had given you 20 years ago, subscribe. The next one is on what changed about Social Security claiming math after 2020, and you won't want to miss it. Anchor 3. Dry powder, a deliberate cash reserve, sized not to a percentage, but to your actual spending needs. The historical record is brutally consistent. The average bear market takes about a year to bottom and several years to recover. Retirees who had 2 to 3 years of spending in cash and short-term treasuries at the start of every major crash did not have to sell stocks at the bottom. Retirees without it did. The mechanism is that cash buys you time, and time is the only thing a crashing market can't take from you. If you have 3 years of expenses in T-bills and a money market fund, you can let your stocks fall 50% and recover without ever realizing the loss. You spend the cash, the stocks come back. The mathematics of compounding does its job. Now, here's where I have to be honest with you. Cash loses to inflation. Over the long run, holding too much cash is one of the biggest wealth destroyers in personal finance. From 2009 to 2021, holding 3 years of expenses in cash cost investors enormous gains they could have made in stocks. The point of dry powder isn't to maximize returns. It's to make sure you don't have to sell at the wrong time. It's insurance, and insurance has a cost. How to act on it? Calculate your essential annual spending, not your aspirational spending, your real number, including taxes and healthcare. Multiply by 2 for a minimum, 3 for a comfortable reserve. That number in T-bills, money market funds, or short-duration treasury funds is your dry powder. Anything beyond 3 years is probably too much. Anything under 1 year for someone in retirement is too little. And one note before the action steps. Everything I'm telling you is based on historical data and general principles. It's education, not personal financial advice. Your tax situation, your health, your housing, your family, none of that is in this video. Verify with a fiduciary advisor who knows your full picture. Let's make this real. Say you're 62 with $400,000 in a traditional 60-40 retirement account. 60%, $240,000, in a total stock market fund. 40%, $160,000, in a total bond fund, mostly intermediate corporates. You plan to retire at 65 and spend $40,000 a year from the portfolio on top of Social Security. A 2008-style crash hits in your first year of retirement. Stocks fall 57%. Your $240,000 in stocks becomes about $103,000. Your corporate bonds, which behaved more like stocks than people expected in 2008, fall maybe 10%. Your $160,000 becomes $144,000. Total portfolio, $247,000. You still need to pull out $40,000 to live on. You sell from both. You now have about $207,000 left, and the market hasn't bottomed yet. Now run the same scenario as a 3-anchor portfolio. 45% stocks, $180,000. 20% long treasuries, $80,000. 10% gold, $40,000. 15% dividend-focused equity, $60,000. 10% in T-bills and short treasuries as dry powder, $40,000. Stocks fall 57%, $77,000 left. Long treasuries rally roughly 20%, $96,000. Gold roughly flat to up, call it $42,000. Dividend equity falls less and pays you about $2,400 in dividends during the year. Dry powder is untouched and earns a small yield, $41,000. Total about $258,000 plus dividend income. And crucially, you pull your $40,000 from the dry powder, not from stocks at the bottom. Your stocks are free to recover. They do by 2013. The difference 5 years later after recovery is somewhere between $60,000 and $120,000. That gap is what the 3 anchors are worth in a single crash. 3 things to do this week. 1. Open your most recent brokerage and retirement statements and write down, actually on paper, what percentage of your total savings is in each of 3 buckets: stocks and stock funds, bonds and bond funds, and cash or cash equivalents. Then identify which of those bonds are corporate versus government, because they behave very differently in a crash. If you don't know, call your brokerage Monday morning and ask. Most people overestimate their non-correlated allocation by a factor of 2. 2. Calculate your bare-bones annual spending: mortgage or rent, utilities, food, insurance, healthcare, taxes. The number you'd need to survive if the market dropped 50% tomorrow and stayed there for 3 years. Multiply that number by 2. Compare it to how much you actually have in cash and T-bills. If short, that gap is your dry powder shortfall, and closing it is the single most important thing you can do before any crash, including ones nobody is currently predicting. 3. Look up the historical maximum drawdown of every fund you own. Most brokerages show this. If you own a fund that lost more than 35% in 2008 or 2022, and you're within 5 years of retirement, ask yourself honestly whether you have the temperament and the cash reserve to ride that out without selling. If the answer is no, the time to adjust is before the next crash, not during it. I'm not predicting a crash. I'm telling you the conditions that preceded every past one are not going away, and the historical record is the only thing we actually have to work with. Remember Robert and Frank. Same town, same age, same career, same Tuesday in October. Robert had a 60-40 portfolio with corporate bonds and almost no cash reserve. Frank had a portfolio with long treasuries, a dividend sleeve, and 3 years of expenses in T-bills. Frank wasn't smarter. Frank wasn't lucky. Frank had 3 anchors. Robert had 1.5. 18 years later, Robert is still working part-time at 78. Frank retired on schedule and is teaching his grandkids to fish. There are 2 games being played in the market. One is the game of maximum returns, which is the game shown on television, in the brochures, in the apps with the green confetti when you make a trade. That game is for people in their 30s and 40s with decades to recover. The other game is the game of not running out of money before you run out of life. That game is played quietly, with 3 anchors, and it has been won by the same kind of portfolio in every crash of the last 100 years. If this was useful, share it with someone who's within 10 years of retirement. They probably haven't done this math, and the cost of not doing it is measured in years of their life. This is Ban. Stay sharp out there.